Like, it makes no sense that all of these momentum indicators are showing that a bottom is in the equity markets. So why would that be? The only reason that I can come up with is that I think Wall Street is already front running the move, that they know that the Fed is going to have to capitulate in like a massive kind of way and add all these, fake fiat monetary units into the system.
Many central bankers, including Yellen, including Bernanke before her, had carefully studied this disastrous outcome, which was a deflationary credit collapse, and they don't want it to happen again. So it's the least painful way, because if the alternative is, 30% unemployment and higher levels of violence and, basically blood in the streets, they'll turn on the printing press rather than see that kind of an outcome.
What's up, Sats fans? Welcome to Swan Signal. We got another great show for you guys lined up today.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.
It is our quarterly update with the great Preston Pysh and Andy Edstrom. So welcome, you two. How are you? Welcome back to the show.
Good.
Never better, Sam. Got my bull market Bitcoin shirt. Bull market's back, baby.
Well, we'll talk about that. You were on a trip, right, Andy?
Traveling? Oh, well, last week I was just traveling, seeing a few clients. So nothing too
nice.
nothing too fun or exciting. I haven't had a real fun trip probably since probably since Miami. I haven't been traveling enough. I got 3 kids at home, one of which is in a robot competition, which is actually something I want to talk with Preston about. Preston, I think you did a rip with a great episode with Princey that came out recently, and you dropped the news that one of your kids is into robots, and my kid is going to there's a world competition in Texas in May, and we're all going. So that's going to be my next real trip.
Yeah. We're going to the one in Boston. So,
good for you.
Yeah.
That's where all the best roboticists are in Boston.
Yeah.
Around the MIT, Harvard, cluster. What's that robot company that makes the one that
Boston Dynamics. Yeah, they're doing backflips. Is that what your kids are going to be doing? Both your kids, that's robot
pretty much
kids?
all you got to train them to do is just do backflips. Yeah.
Well, I was listening to your guys' last quarterly update just to kind of prep for this show, and you had some good calls in it. I'm not gonna lie.
What
Andy,
were they? What were they?
Look at you. You got. Yeah, I mean, I'm gonna read them to you. Andy, you go. There's signs of a bottom right now. Bitcoin was resilient in FTX, but there was no real volume. That might be a missing ingredient, but the halving timing is around the corner, and that's kind of the timing wise for a sign of a bottom. We got asymmetric upside right now. The risk reward is good for Bitcoin. All right. So this was like December 30th. And then Preston, you goes, Bitcoin will outperform the S&P 500 and NASDAQ in the beginning of this year. There might be more pain, and they'll have to print when something breaks, and that something will probably be credit. And it just depends on where they funnel in that new liquidity. So kind of both things kind of happen. So.
Wow.
Good job, guys.
Sometimes it works.
Well, I want to give Preston one extra hat tip. Correct me if I'm wrong, but I don't know if it was on Twitter or I heard somewhere Preston commenting about how he had recently invested the free cash flow from his business into Bitcoin. And I think that was at much lower prices than where we are sitting right here at the end of the quarter today.
Pretty much right on the bottom. Yeah, I mean, you just get lucky sometimes,
Yeah, I mean, there were some good calls. This quarter's been pretty wild in terms of the price action. Bitcoin's up around 70%. I'll just go through it. Gold's up about 8%, 9% around 2000. The Dixie's down, which is another call that Andy made, was that the dollar was going to top. So that was another great call. The 10-year kind of shot above 4%, and then it just dropped like a rock during this banking crisis down to 3.4%. And same with the 2-year. It was sitting above 5%, and now it dropped below 4%. And so it's been a wild quarter. A lot has happened. So let's just kind of get your general thoughts around, I guess, from January to the end of March here. Like, what are your thoughts about the broader markets, how it kind of went, how you thought it was going to go, and maybe kind of turn it back to Bitcoin at the end? Let's throw it to Andy.
Okay. Well, it's good to be right by virtue of being lucky sometimes, right?
That's right.
Stopped clock is right twice a day. Now, I think that, the general malaise over all financial markets, including and especially Bitcoin, was palpable, a quarter ago when we did this last. I mean, there was still stuff had blown up relatively recently. We hadn't gone long enough really without another domino falling over. And so there was a lot of fear. I mean, there were a lot of people talking about lower prices. Plenty of people we know in the space who were hoping to scoop up cheaper sats. And so, the level of fear suggested a bottom. I didn't have strong conviction, but I do have strong conviction where we sit today that, again, you always caveat, unless something really big in the space blows up, absent that happening, it feels like we bottomed, and it feels like the next bull market is on. And I want to be a little cautious. I do believe in the cycle. I do believe that, the shape of the price chart looks pretty similar to the last 4-year cycle. And so I don't expect massive bull market, 100K by conference day, any of that stuff. But I do at least think we're pretty much out of the weeds. But I'm curious what Preston thinks.
Oh yeah, I think Balaji's 1 million target in the next 50 days is pretty low. I think it's probably going to be about 10 or 50 million. No, I agree with Andy. I think that I think the bottom's in. I think that there could be some massive contagion, but I don't see that as a base case whatsoever. I think they've stepped in, they've backstopped the bond market. Sam, you and I talked about it. What was it, last week down in Miami? That, I mean, this is a form of yield curve control, or at least that's my interpretation of what they're doing. If we were going to just add up all the bonds in the general market, let's say they were at a 15% discount from where most of them were purchased on their balance sheet. So they had a pretty sizable hole, making a lot of these banks insolvent. And so by stepping in and providing this facility at 5% interest, they basically bid a premium into all those bonds that were discounted by 15%, so that now they're only discounted about 5%. So that's a form of yield curve control. If we were talking about a bond that was $1,000 and it's off that mark by 15, and now it's marked back up so that it's only a 5% discount, you're bidding the price by doing something like that. And you're doing it across literally the entire balance sheet of every single bank in the United States. So that's going to stop a lot of the contagion, I think, in banking. But who knows where that pushes the next stress point. I personally think it's going to be commercial real estate. That could take some time to kind of manifest itself, and like how that plays out. And then what's the backstop for that? Because they're going to have to do something to backstop that. That we're going to continue to see this manifest itself. Now, what I'll tell you is the price charts, if you're just looking at price alone and you're looking at it from a momentum standpoint, and I want to emphasize this, I don't make investing decisions off of one metric, right? This is just a metric that I think is important and noteworthy right now. For me, when I'm looking at momentum, Bitcoin hit its momentum stop and it turned green. I think I might have even said that on our last conversation. It continues to remain green. Interestingly, the NASDAQ just on Friday had a momentum shift just based off of the price action. And so when I'm talking about momentum, I'm pretty much talking about two major things: an ATR, which is an average true range, which is basically looking at the volatility that Like the NASDAQ has a certain amount of volatility. Bitcoin has a certain amount of volatility. And when that volatility shifts or changes in a direction that's out of the normal trend that it's in, that's a trigger. That's half of how I look at momentum. The other half is just moving averages, like short duration moving averages versus long duration moving averages when they cross over. So when I look at those two metrics and I look at the NASDAQ, it is now green on both of those for the first time in, I would say, January of 2022. So it's been red for more than a year on the momentum. That literally shifted on Friday for the NASDAQ. Bitcoin was probably like back around Christmas time or somewhere around there. And so what I find so interesting about, and why I'm bringing this up is a lot of your indices, equity indices, are suggesting that maybe a trend change is in the works. But yet when we look at unemployment and we look at how inverted short duration versus long duration debt is, it's suggesting that we're getting ready for a big capitulation event in equities based on historic metrics. And so what I'm looking at, and I'm saying to myself, this isn't right. This doesn't look like it normally does, or at least how it's normally looked for like the last 40 years. What I think you might be seeing, and I'm going to use an engineering example, people have probably heard of harmonic or resonant frequency. When you start hitting resonant frequency, the input that's being supplied into a vibrating system, when you hit resonant frequency, the system is coming back at the exact same moment that the input's being supplied. So it's 180 degrees out of phase. It's at the exact worst moment that you could possibly time it. So like another example would be like if we were looking at a kid on a swing and they were swinging back and forth. When you push the kid, if you want to get the most bang for your buck, is like as they're starting to go back down is when you want to give them a push. If they were coming at you and you tried to supply the input as they're coming at you, that would be an extremely disruptive event. And the way I see what's happening in the markets right now is you're almost having this resonant frequency that's playing out in the markets where everybody in the market knows they got to supply more liquidity and more monetary units into the system. But it's happening at this point in time where the real economy, where real people are working, is desperate for, like, the liquidity is not trickling down into that part of the economy. So what I think you might actually see by all these momentum indicators suggesting that equities are getting ready to rip right at the moment when you would probably least expect it if you were looking in like a historical context, is this maybe like financial resonant frequency that's playing out right now, which I find extremely strange. But that's why I pay attention to momentum metrics, is because it helps me look at the market and remove whatever I personally think is going to happen based off of emotion, and just looking at the pure math of these indicators that typically steer me. They really help me with timing. I like to find things that are deeply discounted that I think have a really long-term value, but I like to get the timing. I try to get the timing as right as possible when I use momentum metrics to help me facilitate that. Sorry, there was a lot of different things.
Anything off that? No, I love it. I love it. I love
interesting times. Amazing. Yeah, no, I think momentum is a useful tool, exactly as Preston described, for timing when you want to place bets, especially longer term ones. I watch Liquidity too. I'm a fan of Michael Howell, who does this in depth. I can't remember the name of his organization, but he really tracks
cross
that
border.
Sounds right. Yep, capital. You nailed it, Sam. And he tracks global liquidity, and liquidity. I think we've all learned by this point that Bitcoin price, at least, is in large degree a measure of global liquidity trends. And so, and by the way, most assets are also. Bitcoin's not unique in that respect, except for it's sort of more extreme, right? I mean, it's definitely the canary in the coal mine on global liquidity, if you strip out other things like, the 4-year cycle and the halving. And his indicators had shown a rise in liquidity in the first quarter, which is when, let's say, lots of assets performed better than some people thought they would. But it's also showing a slowdown and possible reversal in that indicator, at least on a global basis. And Bitcoin is a global asset. So we'll see, we'll see what happens. I am by no means, short term calling a, bullish momentum like pile on the train. I never do that. But expect reversals and retracels and retesting of prior key levels. But that's another thing that I pay attention to is liquidity.
So we can look at liquidity and momentum indicators in the short term. It seems like the markets are believing that the Fed's new liquidity programs are enough to fend off a full-blown financial crisis. And now analysts are more worried about kind of shaken banking industry and having tightening credit and what that's going to do to the economy. And so how do you guys think through that? Because it's hard for me to, I think about two things. I think about 2019 in Bitcoin. This feels super similar to me, where you had Bitcoin kind of rise up out of nowhere and it gets up to 13K and then it dropped all the way back down to 7K around the summer. And then it actually ended the year around 7K before 2020 when it raised up. And then it also reminds me of 2008 in the equity markets, where there was that period where equities actually ripped, but then then it kind of crashed in the fall as well, because there's an actual real economy out there that's struggling. And if there's decreased lending from the shaking banking industry, I'm not going to lie, it's hard for me to get more medium to longer term, I guess medium term bullish right now when I look at this banking industry and how we won't have more a drop down, maybe back to retest some of these levels before we kind of go up to this new bull market. So how do you guys think through that? I know that was kind of a long question.
I completely agree with you. I'm hesitant as to how aggressive this could go without the tailwind of central banks kind of really inserting quite a bit of liquidity into the system. I think all of the backstops that you're seeing are not manifesting themselves back into the lower levels of the economy, where when you look at 2020 COVID policies, I mean, they were literally writing checks to every person in the United States. So it's way different the way that they're kind of handling this. When I look at right now versus any moment in Bitcoin's history, I think it's different. And the reason I think it's different is because you literally have a battle taking place with respect to the global settlement layer that you haven't had happen historically. And in particular, just this past couple days, when we see the OPEC plus decision to be cutting oil, this is huge. This is a really, really big deal. And the reason it's such a big deal is because if they're able to ensure that the price of energy is not dropping with what I think everybody was expecting prior to last week, that they would naturally see in the economy, because we're getting ready to go into a recession and that whole narrative. If OPEC is purposely reducing supply to keep those prices not only up, but maybe making new highs, I cannot even imagine what this means for the treasury market and for the prices in the treasury market. It has the potential to really wreak havoc with the central bankers' plans to quote unquote control what's about to take place. Because the whole thing with this backstop, the facility that they stood up, the idea is, okay, put these bonds on deposit here. We'll pay you par. And the whole strategy is we're going to have a recession within a year, and then we can push them back onto your balance sheet, and it's going to appear like we borrowed the electron and gave it back, and there was nothing that happened, right? That's the strategy. And so with OPEC plus stepping in and trying to manipulate the price of oil and the energy input to literally all supply chains around the world, if you can't get inflation under control, well, you're not going to be able to get the prices of credit under control either. And so that is going to be a major, that's the number one thing I'm watching in the second into the third quarter is, are energy prices actually going up? If they are, Like, I don't care what you say about inflation, but it's going to impact inflation, and it's going to impact the credit markets, and it's going to be chaotic, to say the least.
Yeah, that's really well put, Preston. I think zooming out helps too, which is, we've definitely been seeing a decrease in inflation, however you measure it, lately. I still think the 2020s are going to be wild times in general, including for inflation. So yeah, we'll see these short-term peaks and valleys, but I hope I'm wrong. I hope they get inflation right back in line like they always used to, but I'm concerned that they won't. And then the other consideration is, and I haven't looked at the futures curve, Fed funds futures curve yet since the oil announcement, but remember recently the market, at least implied by the Fed funds futures curve, had been pricing in several rate cuts already at the latter half of this year. And so if asset prices were based on rate cuts already coming, and those rate cuts don't come, either for the reason that Preston mentioned or for some other reason, then yeah, you could have a re-rating of all asset prices downward as a result.
Sam, so Luke Roman had probably one of the best analogies when it comes to this particular dynamic that's playing out. He says over-indebted Western policymakers are effectively trying to control the market through rate hikes, oil price caps through the SPR, however you want to say that they're doing it, and sanctions. And he's saying this is like the equivalent of Kevin Costner when he's in the scene Field of Dreams with taking the gun in his pocket. Well, he didn't have a gun. It was just his finger, right? And he's like basically like, holding him hostage. And James Earl Jones just looks at him like, okay, so you're clearly lying. And he goes and gets a crowbar and he's running after him with a crowbar. And he's like, there are no rules in this scenario. And the crowbar is effectively OPEC saying, you know what, you want to play these games, bring it on. Because here's the game. We're going to keep the energy prices high. Hell, maybe we'll even put in some new highs this year, and let's see how you guys handle that. So like the gloves are off. It's a fight for what that new settlement layer is. And when we think about this, I've been using this example in a couple different discussions recently. But Michael Saylor always talks about deflection, and like if you're going to build a building on bedrock, you like want bedrock that doesn't deflect. And when you think about this legacy financial system, the bedrock is the treasury market. It's this European, US, Japan treasury market that for 40 years has just always increased in value. So if you're building on top of that, there's nothing better to build on than something that's getting stronger. And so that's what everybody's become accustomed to over the last 40 years, is that they're building on top of this treasury market that only goes up in value. And now all of a sudden it's starting to deflect. And people are saying, hold, what was that? What was that deflection I just felt? Right. And
Earthquakes.
Exactly. And OPEC is like, you know what? We're going to ramp this up, and we're going to really put some deflection into this bedrock. That's what I think is playing out here in the coming 2 quarters.
Yeah, and it's right at that time where they have that, quote unquote temporary liquidity program that's just trying to buy time for these banks, like you said. And then they do it now. It makes you think like what their intentions are, whether this is just because they're seeing decreased demand, or if they're like, oh no, we have power here. We have real resources. You guys have paper power. We have real resources, and we're going to make the price of oil stay elevated. I just feel like the price of oil is this X factor when it comes to the overall inflation picture. And that obviously impacts central bank policy, and then that affects assets more broadly. And so this higher for longer camp, now that we have this surprise OPEC cut, like this could affect all asset classes. And like what Andy said, kind of reset the clock for when people think this quote unquote Fed pivot is going to be when it comes to rate cuts. And so all assets will be affected by that. And we kind of saw the treasury market, like you said, get some trembles in there when the move, which is a measure of bond market, treasury market volatility, just spiked, right? And then they laid out these liquidity programs and it kind of fell back down, but it's still extremely elevated. And you're seeing kind of these auctions have really long tails. And so do you think, Preston, because you talked about what will cause a Fed to pivot. Are we seeing like this credit market start to seize up, or was it the banking industry that we just saw kind of go through a crisis? Are these signs of that kind of dysfunction that you thought would happen, or do you think we have something kind of bigger coming down the pipeline?
I think this is going to be huge, what's coming down the pipe. At the same time, I think market participants are already front running the move. I think the market is looking at this and saying, "Oh, well, they're completely inept at this point, and they're going to have to print at levels that like this backstop that they did is just the tip of the iceberg, right? Like where this is about to go is going to be so inflationary, and when I say inflationary, I mean monetary unit M2 units being added into the system, that I think everybody's starting to front run it. And so that goes back to my when I'm talking about resonant frequency in the market. Like it makes no sense that all of these momentum indicators are showing that a bottom is in the equity markets. So why would that be? The only reason that I can come up with is that I think Wall Street is already front running the move, that they know that the Fed is going to have to capitulate in like a massive kind of way and add all these, fake fiat monetary units into the system. And how they get added, I they're trying to do it very surgical right now, but I think it's going to the impairment is going to be so bad that they're going to have to just literally just spread it everywhere. Like there's going to be no escaping the amount of the units that they're going to have to add because of this. And you got to think about it. Like, sorry to keep going. One final point is just, if they can't get the inflation under control, like the whole credit market is still like in yield terms is less than the yield that you're getting in credit is less than what you're seeing in inflation. And so if inflation starts rearing its head again, like all these bond traders who have just been getting annihilated for 2 years now, they're going to say, my God, it's still not over. And so they have to come out of those positions even further, which then just, where does all that buying power go? It has to go somewhere with a fixed supply of units, which is Bitcoin, equity, commodities. Yeah.
And then the yields go up, and then the interest payments on the debt go
spiral.
up.
You're in a spiral.
And you just see this. Yeah. That's the spiral.
That's the debt spiral. I would add to, I'm a subscriber to the cockroach theory when you're talking about, bodies float into the surface. There's never only one, right? So we had the first weakest, but sizable institutions fail. SVB was, a bigger failure than I think many people expected. But of course, they had unique weaknesses like all this hot deposit money way beyond the insurance levels, and they bought too many long duration bonds. So they were extremely weak, and Signature and Silvergate had their issues too. But yeah, it would be rare in the scope of financial history where you have just pick a number, only 4 failures, but not 5. And so that is the most likely catalyst for me, for more Fed action. Yeah, I mean, it could just be the curve or vol in bonds, getting out of control and failed auctions. That's definitely a possible vector. And if it's not that vector, then yeah, it could be more institutions failing.
Sam, this is the question. So like, when you look at the sheer size of the credit markets, it's massive compared to everything else. And if it continues to sell off because they can't get inflation under control, where does that buying power nest itself? Like there's not too many other places it can go. And those markets where it can go are much smaller in market cap size than the credit markets. So like you have to ask yourself, it has to go into something that has some type of scarce supply to it. So that's when you're talking equity, you're only talking about equity that is actually free cash flow positive if they're not going to debase their shares. So when you look at the equity market, Andy, how much of the equity market do you think is not positive free cash flows? Like 40% of it?
Big chunk, yeah, a third at least.
It's way more. Yeah, probably a third. It's way more than people realize of the amount of equity that's not profitable. So like as all this buying power is coming out of credit and it's trying to nest itself in places that aren't going to get debased, You have to go to equity that's free cash flow positive. You can put it in commodities, but then you run into like doing commodities is really tricky because you have to really understand the supply demand dynamics as the price gets bid, similar to like gold, who's ever manufacturing that is trying to produce as much more of it as they can, which is a form of debasement. So like really the thing to own is Bitcoin for people that understand it, and free cash flow equity. And those are really small market caps compared to this thing that just can't seem to get under control and that just keeps selling off. So yeah.
Bitcoin's tiny.
Minuscule,
very tiny.
Minuscule. And when you match that size, that really small size, to the psychopaths that own it, and I keep using that term because I don't know how else to describe the holders of it, because their conviction is so over the top because they understand what they own. And when we go through a situation where Bitcoin has sold off for the past year and a half and has been punished in the price, like the people that are buying that, and you can see this with on-chain data, the people that are buying these things are people who just hold them forever and they never put them back on the market because they know what they own. And so we're at this really interesting situation right now at this moment in time where I think the price has been overly punished, way more than what we've had in the cycle before. And I think the conviction and the knowledge that's out there that of the psychopath holders is even stronger than anything we've seen before, at a time where debasement is likely to be unprecedented moving forward in the next 2 years.
It's so true. Most of us haven't been through as many cycles in Bitcoin as Preston has. I guess this is my second, and I had this conversation with my dad. I think it was pretty recently. It was somewhere when we were, down below 20K, and talking about the mark-to-market loss, and you're down so much from the last peak, and he struggled to wrap his head around the notion that Bitcoiners have seen so much volatility, and especially if you've been through more than one cycle, like unless you lose your job, right? Unless you have to feed yourself or your family, right? Unless you have to sell sats to literally put food on the table, Bitcoiners will go to extremes to hold on to those sats. They will sell the car and buy the crappy motorbike like American HODL. They will, they'll cancel all the luxuries, all the travel. They'll do what it takes basically to cling to those sats. And then you look at the data on when coins have moved, and you see that the fair weather traders, the recent vintages of coins have long cleared out. Those guys are gone. The tourists are long gone. You realize how that base and that bottom gets formed by those psychopaths who we know and love.
Here's another thing about the psychopaths. At least the people that I've met when you go do like a live event, they're net producers. They're people that are generating personally free cash flows in their life. And so who can afford to experience volatility and not sell at a bottom, but somebody who has free cash flows that doesn't have to sell at the bottom, right? That's the difference. So like the Michael Saylors, who, his company's banging out free cash flows, he doesn't have to sell. He doesn't have, it's not like he's a hedge fund manager and everybody's mad at him because he's down. Like, heck, if the shareholders are selling their shares and he thinks the shares are at a discount and is going to give him a better value than the Bitcoin, he'll start buying his shares back with his free cash flows, right? That's the difference.
Yeah. They're actually producing value too to stack more
exactly
because they're psychopaths. I think the volatility, once you've been in a few cycles, like it really hardens you. Like I barely feel anything when it drops from these levels. And I know that might be surprising to somebody who just came to Bitcoin, but you hear it a lot from people in Bitcoin who's been here for a long time. You kind of used to the volatility, and this is just how it goes. And I think it's actually very healthy what we've seen in this bear market with how many of these bad actors have gotten wiped out and how actually resilient Bitcoin has been while they've gotten wiped out. And now here we are at like 28K, and it bottomed, quote unquote, at 15K. And this is kind of what we see over the long period of time, where it kind of makes these higher lows And it's very volatile in the short term, but you zoom out and you kind of just see it going up. And Bitcoiners know that because we studied it. And so we're not going to sell this stuff. And that's why like 68% of these things haven't moved in a year. And that's kind of the stat we've been referencing. So I agree. I think it is likely that we've kind of hit a bottom. I think it could be the price could fluctuate here and it could be kind of extra volatile, but still, I mean, we have these psychopaths that will not sell. And that's what Stanley Druckenmiller said. Right?
That was exactly Stan's point. Yeah.
Yeah. Did you see that? It dropped 80%. And these psychopaths didn't even
flinch.
Sell.
Sam, I got a question. I don't know if Andy's got an opinion on the Chokepoint 2 stuff. I'm curious what his thoughts are there.
Yeah. Let's get into it.
Well,
Andy, what do you think?
Yeah, I think facts and circumstances suggest that there's coordinated action. I mean, it's too convenient that all these moves by various agencies, whether it's FDIC or Fed or Treasury, Signature Bank. So I just Barron's interviewed Barney Frank, and published it over the weekend. He clearly thinks that they didn't need to be taken, out back to the woodshed, and yet they were. And we know that several members of the administration have never been friendly to Bitcoin. And crypto, I mean, all the nonsense and the fraud and the schemes gave them a golden opportunity to attack the whole space, such as it is. And why wouldn't they? Especially when you've got Liz Warren, Senator Karen, spouting off about how she's going to raise an undead army to attack crypto. So yeah, I mean, it's obvious, right? It's obviously coordinated. I don't know what the result will be. Oh, I didn't even mention Custodia and Caitlin Long's attempt at a narrow bank, essentially to serve the Bitcoin space. So yeah, all the facts and circumstances indicate coordinated action is all I have to say.
So when I completely agree with you, what are they going to do about Square, Fidelity, NASDAQ, I guess, is wanting to get into the custody game. So like, in my opinion, you're dealing with multi-billion-dollar enterprises here that have already, integrated the rails of the future and the money of the future into their way of doing business. And I don't think that they can be so easily manipulated by the government hammer with all the Wall Street competitors when we look at those three in particular, because they're just so massive. So do you have any thoughts around
guys? It's a great point. Fidelity has a unique position in not being a public company, being private, so they can kind of do what they want. They've been in it for so long now. They've been in Bitcoin, I think, since 2013, roughly, if I'm remembering correctly. And these are big institutions. They have real clout. Fidelity, in particular in Massachusetts, we need to get Senator Warren in a room with not Abby Jessica, Abby, what is her name? The CEO. Yes.
Johnson.
Yeah.
Abigail Johnson.
Get a meeting of the minds. I'm sure that would go great. So yeah, it's there's this asset is big enough, and there are powerful enough people and institutions that it's going to find a home. And the banks too. I was surprised to learn that the number of banks, I think Caitlin provided this statistic, the number of banks that have been banking quote unquote crypto in some capacity was like over 100. And I don't know who all those institutions are, but there's going to be scrappy players that pick up the pieces that want the business, even though government has made it harder for them. My guess is somebody will be willing to do it because there's money to be made.
Yeah.
What do you think, Preston?
No, I agree with you. I when I'm looking at everything that's happening, I think everybody kicking and screaming about it is raising great awareness, and I think it needs to be raised. And I think the thing with Signature was very suspect, and the fact that you have Barney there, who basically drafted all of the global financial crisis legislation and stuff, was literally sitting on the board, is way too ironic. But yeah, I think it's important to highlight that, but I think it's also important to shine a spotlight over on areas that are large, multi-billion-dollar banks and platforms that have it fully integrated. I mean, as far as Square goes, like going on the Cash App, like it is just too easy. Like it's insane to go on there and conduct a buy, route it over to the Lightning Network seamlessly. Like the person using Cash App doesn't even know if they're on layer 1 or layer 2. It's completely seamless to them. And so like they are so far out in front of it. And I don't know what their market cap is, but I would guess it's like a 40 to $50 billion enterprise. Like good luck. Like good luck going up against their lawyers. I can only imagine what kind of lawyer they could hire.
Fidelity too. I mean, Fidelity is just this big behemoth in the traditional financial industry, and they just released their product for Bitcoin buying to their retail clients. Some like 37 million retail accounts can now buy Bitcoin. Now, I'll be interested to see if they allow self custody.
I think that's
kind of the next step.
Luckily, we have Square demonstrating it to the whole U.S. what right looks like. But yeah, that's my concern too, Sam, is that you get a Fidelity and then you get this initiative that people aren't allowed the custody out of these holdings and you have to keep it on, because that's whenever you get all the cash settled derivatives activities. And like we need, as a community, need to really beat the drum on. So, hey, Fidelity, when are you going to allow people to withdraw their assets off of your platform into self-custody? Like it is so important for people to really hammer that home online and with whoever.
So critical. That's one of the actual real attack vectors on Bitcoin, is sucking coins into third parties that can be controlled.
I mean, I would argue the whole FTX was exactly that. Like, so, you know, the pain that's been endured over the last year and a half was purely because of bad actors, obviously, and then the fact that they were basically issuing paper Bitcoins and nobody was the wiser. Now, did it work itself out? Of course it did. Will it continue to work itself out? I think no matter what, it always will, because you always have the option to take it. But if entities get too big and the collective conscious of everybody participating in the market is just to be lazy and to not take self-custody or demand self-custody out of these really large institutions, I think that you're setting yourself up for a potential painful experience and manipulation.
Yeah. Yeah, I think these crypto casinos collapsing too. We saw a ton of Bitcoin get withdrawn from those exchanges, which was one of the positives of the whole debacle. And users maybe will start demanding this of Fidelity, right? And maybe they'll just respond to users in the marketplace, be like, hey, they want this, and also they need this. Like, look at the counterparty risk that exists. Like, we want to give our users this. So maybe the users themselves will just force Fidelity's hand to start doing it, which would be great. Well, Preston, you talked about how the money has to go somewhere from this giant credit market, and Bitcoin is obviously one of them, but real estate's probably another one. And you brought up like commercial real estate. So let's talk about that right now, because it got a lot of headlines recently, because obviously commercial real estate has had a lot of headwinds the last couple of years, not only like work from home, those kind of trends leading to increased vacancy rates. You also have rising interest rates, which is increasing the financing for these projects and eating into their profit margins. And so a lot of people are worried, because a lot of these commercial real estate loans are sitting on these banks' balance sheets, and around 70 to 80% of them are sitting on regional bank balance sheets. And so they're looking at this. They're like, this is the next shoe to drop. And so what do you guys think about the real estate market and how you kind of see it playing out from here?
So it's not high frequency cap rates, like this is very low frequency turnover type stuff. So it kind of, once it starts getting moving, it's going to pick up steam, and then it's going to really pick up steam, and it's going to take time to kind of express itself in the disaster that it is. At the end of the day, I think COVID, work from home type things was one major part of it. But I think the other part that few talk about is just when you have a 0% interest rate environment that persisted for a decade, you are going to get an incentive structure that highly encourages people to go out there and build like crazy, and just have way more infrastructure than what's needed, because the cost to the startup cost to build it and put it in place is super cheap. Now, what people aren't talking about is at higher rates, when you look at the capex that's required to sustain these buildings that go through all sorts of depreciation, that's where I think people who really understand the game are looking at this and saying, oh, this is a disaster. Because after I look at the amount of people that are actually using the building, all these buildings that have been constructed, it's way less. Let's say they were expecting 95% occupancy, and now all of a sudden it looks like it's 90 or 85% occupancy. And you're dealing with capital expenditures due to depreciation that are sky high compared to what they probably were using in their estimates when rates were nothing percent. You get drastically different cap rates for all of this real estate. So yeah, I think that's what's taking place. But back to what I originally said, the frequency at which this takes place for this to be realized into the market is way slower than other things. Like I look at Bitcoin as being like the highest frequency kind of movements, where real estate would be pretty much on the opposite end of that spectrum.
That's well said. Preston, you made a really good point about how long the buildup occurred. I mean, I've been watching commercial real estate, with one eye for years and years and years, and the cap rates got insane. And by the way, for people who aren't familiar with cap rates, probably the easiest way to think about it is like the cash flow yield, like the interest rate on a bond. It's like, what's the cash flow equivalent that this asset is going to pay you, which is the inverse basically of the price, at least in terms of how expensive the asset is. And these cap rates got really, really skinny. Which is sort of like saying, interest rates got really, really low, everything priced downward, and it got to a ridiculous level. So way out of bounds. This asset got way out of bounds, and you get a structural shift, and there's going to be problems. Preston's right. It's going to take a while to work itself out, with the partial caveat that some of those structures have floating interest rate loans attached to them. I mean, many of them have fixed rate loans, but we've already seen a few cases where big real estate buyers like Brookfield, these guys are one of the biggest real estate owners in the world, have already handed over the keys, to some of these office buildings. They're saying there's no way we're going to, salvage our equity value. We're out. So we'll see some more bodies floating up, and it'll take months and months. I think it's important to frame the size of the asset. So commercial real estate is, first of all, it's not as big as residential real estate in terms of the total value, but residential real estate is literally the world's biggest asset, right? So commercial real estate, if you want to categorize it that way, is the number 2 asset class in the world. Office space is like somewhere between a fifth and a quarter of the total, right? Because you've got warehouses, you've got multifamily residential, you've got retail, you got data centers, you got all these other sort of subclasses in commercial. I do think the office space segment will be the hardest hit, although it won't be the only one hit. With work from home at least receding somewhat, people are venturing out to stores a little bit, which means warehouse projects aren't looking so great as a couple years ago when Amazon was opening them at record rates. So yeah, it's a significant component of a big asset class. It's not the same as the housing bubble that we had in 2007, 2008. That was truly massive. That's where you had zero equity in a lot of these deals. At least in commercial real estate, you get, call it a quarter of the purchase price as equity. But it's going to be painful, and it's going to take a while to work out.
If we get commercial real estate start to get hit, can that trickle into residential real estate? Like, is that how it typically happens?
Yeah, I mean, none of these markets are truly independent. I'll never forget when I first when I graduated college, when I first moved to New York to work on Wall Street. My first apartment was in a building that had been office space, and then 9/11 happened, and they didn't need the office space, so they converted the whole thing. This was a high-rise to residential. Now, that's expensive, and it takes time, but there are some substitution effects between these different asset classes. Now, having said that, you've gotten to the point where it's pretty specialized. I mean, you're not going to repurpose. Well, you can, in some cases, repurpose an office building to a data center, but it's really expensive. So there's some overlap, but it's not a lot.
Okay. So, I mean, just thinking about the second order effects of that, if we do see a big drawdown in commercial real estate and these banks hold it, I mean, this is when like people like the more deflationists start to say, well, that's going to result in a credit crunch. That's going to result in decreased lending in the economy, and it's going to cause a kind of deflationary credit spiral. So how do you guys work through that? And, you know, I just think about it, just my mind just goes to the huge deficits we're running immediately when I think about any kind of deflationary credit spiral and what would happen in that scenario. And so I wanted to get your guys' thoughts around that.
I think they're going to backstop it just like they did the bond market. I think when you look at the sheer size of it and the amount of impairment that's probably going to pop out of it, they're going to have to do something to backstop the amount. Now, what's interesting is that's going to be another surgical like tool that doesn't benefit the masses. It benefits a small, unique group of people that are in that space that are getting impaired by the valuations. So, yeah. Now, whether they actually can do this on private debt, right? That's where it only gets more stickier and messier with respect to the overall manipulation in the market. But yeah, I think that's where it's going to go. I think they're going to have to do that, and the reason that they're going to have to do it is because if they don't, the cascading impairment that naturally happens out of a fractional reserve system would expose the farce of all of it. So they have to do that. I don't know if Andy would agree, but that's where I see it going.
Yeah, I never say anything with 100% certainty, but let's say 99% certainty, because the Great Depression did happen. It's on the history books. Many central bankers, including Yellen, including Bernanke before her, had carefully studied this disastrous outcome, which was a deflationary credit collapse, and they don't want it to happen again. So, you know, never say 100% certainty, but it's the least painful way, because if the alternative is, you know, 30% unemployment and higher levels of violence and, you know, basically blood in the streets, they'll turn on the printing press rather than see that kind of an outcome.
Yeah, I wanted to read that. This was one of the best articles I read at the Financial Times ever, maybe. It was called The Unstoppable Rise of Government Rescues. And I wanted to read just a little bit from it. And it said, let's see here. The latest bank runs show that the easy money era is not over. Inflation is back, so central banks are tightening, but the rescue reflex is still gaining strength. The stronger it grows, the less dynamic capitalism becomes. And then it goes on, instead of re-energizing the economy, the maximalist rescue culture is bloating and thereby destabilizing the global financial system. As fragility grows, each new rescue hardens the case for the next one. And I think what the author is saying here is that there's this reflex, really since, I don't even know, maybe long-term capital management, to save anything that happens. And even though the central banks are still raising interest rates and trying to fight inflation, we saw that immediately when things started to get bad and start to get shaky, these governments, whether it was the Treasury, FDIC, and the Fed, got together and they said, we got to do something to fix it. So they just refuse to do nothing. And that's kind of the big problem. And I think that's what we both just said here is like, they're going to come in because it's the only thing they know how to do. And they just cannot handle just letting it go. And so,
Sam, I love it
because
because at the core, you have to ask yourself, why are prices going up? Why are we seeing prices going up? And you'll get a whole bunch of answers on that particular point. But I think one of the most important ones to focus on is things are going up in price because the global cooperation that's happening between entities is breaking down. People don't trust each other, whether it's looking at the nation state level between like NATO and all the BRIC nations, that's eroding, that's breaking down. Okay. So if that's breaking down, what's happening underneath of that down at the company level? It's breaking down. And the reason it's breaking down is because you don't have as many companies that can supply pieces and parts, and there's fewer. And so that introduces fragility into the system. So now you have it breaking down there. And so when you look at how are they planning to solve this fundamental issue that's causing prices to go up, which is an erosion of trust and cooperation amongst people, and you look at the solution that they're supplying, which is let's just manipulate the units and who's accountable, and let's backstop people that should be responsible for impairment, and let's not let that happen because the number's just too big. And what you're doing is you're actually supplying more of the thing that's causing the prices to go up in the first place, which is an erosion of trust and cooperation. So, unless I see that trend change, like none of these actions are going to make it better. The actions are actually going to amplify the results, which aren't good.
That's right. Yeah. Chancellor will be on the brink of third bailout for banks, and then Chancellor will be on the brink of fourth bailout for banks, and on the show goes.
Well, thank you, gentlemen, for coming on for another quarterly update. Really appreciate your insights, and it was great talking to you today.
If you care about your financial future, you need to check out a couple of our offerings, including Swan IRA and Swan Private. Swan Private is our white glove concierge service where you get a trusted partner on your Bitcoin journey. We offer all kinds of education and research projects, as well as exclusive events to our Swan Private customers. Check it out today at swan.com/private. Also, Swan IRA. Swan IRA is the best way to gain exposure to real Bitcoin in a tax-advantaged account, like a traditional IRA, a Roth IRA, or rolling over your 401k. So if that interests you, check it out at swan.com/IRA today.